Lockheed Martin, ticker LMT, turned $75.05 billion of revenue into a net margin of 8%. Very few companies keep that much of what they earn. Here is how the aerospace and defense company does it. Founded in 1912 and based in Bethesda, Maryland, Lockheed builds combat aircraft, missile defense systems, military helicopters, and national security satellites, selling mostly to the U.S. government and allied nations through foreign military sales. Shares are up about 40% over the past year, swinging between $414 and $672 before settling near $588, above both the 50 and 200-day averages, with a relative strength reading near 66 hinting at overbought territory. That climb hasn't lifted earnings per share the same way. EPS peaked at $27.55 in 2023, slipped to $22.31, and now sits at $21.49, even as revenue keeps growing. This looks more like a margin story than a growth story. The balance sheet explains part of it. Total debt sits at $21.7 billion against just $6.72 billion in equity, a debt-to-equity ratio above 2. That thin equity base is also why return on equity reads an eye-catching 89%. On valuation, shares trade near 21.7 times earnings, a PEG ratio near 1.2 that weighs growth into that price tag, and a dividend yield above 2%, with enterprise value to EBITDA near 15.7 times. Against its peers, Lockheed actually looks cheap. RTX trades near 39 times earnings, Boeing over 84 times, and General Dynamics around 24 times, making Lockheed the least expensive of the group on that measure. But its price-to-book of 15.4 times dwarfs RTX's 4.5 and General Dynamics' 3.9, a reflection of that thin equity cushion again. Annualized volatility sits near 27%, and the stock has seen a maximum drawdown of almost 27% from peak to trough. Yet its beta against the S&P 500 is close to zero, meaning its price moves almost independently of the broader market, a pattern typical of defense contractors tied to government budgets. The overall picture is a company converting steady government demand into cash flow that bounced back to about $6.9 billion, trading cheap on earnings next to Boeing and RTX, but expensive on book value, and carrying real debt against a thin equity cushion. How you weigh cash generation against that balance sheet risk shapes the whole story. If this breakdown helped, subscribe so you catch the next one. Which defense or industrial name should we break down next? Let us know in the comments. And to be clear, this is analysis, not investment advice, so always do your own research before deciding anything.